Still here, we do it before. We put it back.
Great.
Huh?
All right, we please call the roll. Bring me in order.
Governor Michelle Williams-Rishon. Land Commissioner Stephanie Garcia Richard. Treasurer Laura Montoya. PFA Secretary Wayne Props. Present. Nick Tejas. Present. Catherine Allen.
Present.
Don Bingaman.
Present.
Kelly O'Donnell.
Present.
Alan Sanchez.
Present.
Kurt Summer.
Present.
Mary Roman.
Present.
Same in the affirmative, we have the
Great. First item on the agenda is approval of the agenda. Do I have a motion for the agenda?
moved.
Motion by member Tejas. Is there a second?
Second.
Second by member Summer there on the phone. We have
Yes.
Treasurer Laura Montoya. PFA Secretary Wayne Props.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Summer.
Yes.
Mary Roman.
Yes.
Same in the affirmative, motion passes.
Okay, now we are on to the approval of the SIC minutes from January 27th, 2026. Is there a motion to approve the minutes?
So moved.
Motion, member Tejas. Is there a second?
Second.
Second, member Summer. Could we have a roll call vote, please?
PFA Secretary Wayne Props.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kurt Summer.
Yes.
Mary Roman.
Yes.
Go back. Kelly O'Donnell.
Yes.
Same in the affirmative, motion passes.
Okay, now we're on to section 2 of our agenda. We'll begin with our SIO briefing. Mr. Porter.
Thank you. Good morning, Mr. Chair and members. First, I'd just like to note that Chris Cassidy will be joining us via Zoom today for his presentations. Our team tries to always be here in person, but he's at some critical meetings out in California. Apart from that, I'd like to give a wrap up of the legislative session. There were a number of bills that would have created new funds. A total of potential 9 new funds were considered by the legislature. Many of these were considered not germane for the 30-day session and therefore didn't move through the process. But one of them, House Bill 371, which would have created the Land Grant Merced Asakia Infrastructure Trust Fund, did pass the House but in the Senate. I'm going to be going through some highlights from a great memo that Don and Charlie put together that's included at the end of the diligent book. In case anyone wants to go along, I'm not going to be covering everything, but if you want a more detailed look at what the legislature considered, it's an excellent memo. There were a number of general fund appropriations to and from funds that we manage in House Bill 2. The first was an appropriation of $10 million to the Workforce Development and Apprenticeship Trust Fund, helping to shore that up. Another was a $50 million appropriation to the Behavioral Health Trust Fund. Another was a $2 million appropriation to the Rural Libraries Endowment Fund. And then for the Higher Education Trust Fund, House Bill 2 only appropriated $40 million of that fund's $50.2 million recurring distribution. Sorry, not recurring, but distribution to the Higher Education Program Fund. So the remainder, which is about 10.2 million, will likely revert back to our trust fund at the end of FY27. Similarly, the trust fund distributed 48 million to the program fund in FY27, but House Bill 2 of last year's session only appropriated 22 million. There was not a special appropriation to use the remainder, so the trust fund that we manage is expected to receive an additional $26 million reversion after the audit for FY26. Out of the funds that we manage, there was an appropriation from the Opioid Crisis Restricted Fund of just over $12 million in FY26 and $22.8 million in FY27. This is important to note because the legislature has been appropriating directly out of this fund. And so we may want to reconsider the asset allocation for this fund to enhance liquidity, assuming now that the legislature, having done this 2 years in a row, may continue to do that. So we will probably want to revisit that asset allocation. Also of note is the tax stabilization reserve. The legislature authorized transfer authority of up to $110 million from the tax stabilization reserve if revenues are insufficient to meet budget. There were a handful of bills impacting us that passed both chambers and are awaiting signature by the governor. Just want to focus on two. One was Senate Bill 241. It enacts the Child Care Assistance Act, creating the Universal Child Care Initiative. It also provides temporary funding from the Early Childhood Education and Care Fund of up to $700 million from the corpus of the fund. Also, House Bill 7, it amends the annual distribution of the Workforce Development and Apprenticeship Trust Fund. The amounts coming out of that fund into the program fund started out at $5 million. They were supposed to then ramp down to $3 million a year for the remainder of the life of the fund. But this bill changes it so that it keeps it at that higher $5 million level. So we are anticipating that fund will run out of money a little bit sooner than originally anticipated. Also, this didn't, but I want to talk a little bit about Senate Memorial 9. This would have asked us to study the possibility of buying the Mexico utilities. It failed to make it out of committee in the Senate, but senators talked about how it's not a core competency for us and it could risk the returns that we send back to the state. Just to be clear, there was no specific proposal for SIC to purchase utilities. It was just a broad concept. But the Council Investment Committee did discuss the possibility and public concerns that have been raised. Basically lacking specifics, this concept would have had SIC acquire P&M, but the issue of Blackstone potentially acquiring P&M is currently at PRC. This would have been a little bit of odds with that. And the idea is basically a multi-billion-dollar economically targeted investment that would be judged harshly both for its successes in terms of financial returns that would be reliant on rate hikes, as well as potential losses and liabilities, such as the potential for an inability to deliver reliable, low-cost electricity to New Mexicans. It's important to note that the Constitution prohibits this possibility because we cannot hold more than 10% of the voting stock of a corporation. So while the memorial would have asked us to study it, a constitutional amendment would be required. However, there are other important considerations apart from the constitutional prohibition. One is that a controlling interest would represent a majority of the net asset value for that asset class, creating severe concentration risk. As of December 31st, our real assets portfolio was 4.5 billion. Capitalization of TXNM is currently about 6.5 billion. So majority stake would be about 3.25. However, the Blackstone total acquisition proposal is 11.5 billion. I would also note we are understaffed and working over the next 2 to 3 years to staff up, and having a controlling interest would significantly compound staffing challenges and likely lead to doing 2 jobs poorly rather than 1 job well. We lack core expertise as well as economies of scale for this to be a good investment the way that it might be for either an infrastructure fund or for another utility to buy P&M. Without economies of scale, we would have to make our returns off profits through rates, putting the need to provide returns to the state to pay through K-12 education, for example, and our fiduciary duty to maximize returns for the beneficiaries of our funds at odds with the public's interest in lower rates. Circling back now to the legislative session, we had tremendous legislative support for staffing up and providing pay that's more in line with our peers. There was a unanimous vote in House Appropriations and Finance to significantly increase our budget, primarily our staffing budget. We received a 48.2% increase for staffing, a $10 million increase for contracts, and critically, we got back bar authority
sold, so lower tariffs or tariffs for a shorter period of time than expected could be seen as a tailwind for profitability for those businesses. The primary outcome of the Supreme Court decision seems to be uncertainty regarding the permanence of tariffs and the stickiness of the trade deals that have been struck since Liberation Day. I don't think the uncertainty will have a whole lot of impact on how businesses operate or how they make capital allocation decisions. We've already been living in this world for a while, so it's kind of the new normal post Liberation Day. And businesses have largely shown an ability to adapt pretty quickly and operate pretty well, even amongst the uncertainty. So I think the bigger impact may be geopolitical. If the administration isn't deemed to have the power to do whatever they want regarding trade, they may lose some bargaining power on the trade deals that they've struck and working on. Europe has already said they're going to delay ratifying the trade agreement, and we're back to a one-size-fits-all tariff. So countries that struck a deal for a lower tariff, some of them have seen the tariff rise back up, and so that puts them in a position to have a good argument for why they shouldn't have to adhere to the trade agreement that they've struck because the tariffs have changed. So where do we go from here? So the administration has several additional statutory authorities to impose tariffs in their view. Peter Navarro is the White House Senior Counselor for Trade and Manufacturing, and he published an op-ed in the Financial Times yesterday detailing what a bunch of those different tools are at the administration's disposal. And those include things like different sections of the Trade Expansion Act of 1962 and the Trade Act of 1974. So what they've done initially is set a new across the board 15% tariff, utilizing section 122 of the 1974 Trade Act. That section allows the president to impose tariffs for 150 days without congressional approval under specific circumstances. So some of those include large and serious balance of payments deficits. So it's open to interpretation clearly. That may be challenged in the courts too, but at 150 days limit, I don't think we should expect any kind of a court decision on the legality of these tariffs before they expire. Ultimately, it seems for tariffs to be permanent, Congress needs to pass legislation. Doesn't seem like the administration has any plans to pursue legislation in the near term. That wasn't mentioned in Navarro's op-ed. And obviously, passing legislation would likely be difficult, and that's probably why they're not going down that path at this time. So, interestingly, for public markets, some of the intended consequences, some of the other U.S. geopolitical positions that have been taken in the last year, has been what I would kind of term as a nationalism kind of trade, where we've seen countries prioritize reducing their dependence on the US. Investing in defense, investing in moving trade away from trade with the US, and also moving away from being so dependent on the dollar. So we've seen the dollar depreciate with less demand for US treasuries. Dollar depreciation is a tailwind for international stock returns. We've seen a broad swath of international stocks experience an acceleration in their business fundamentals, and seen their stock prices react accordingly. So think of European defense companies, gold miners and companies supplying with them with equipment as central banks move their currency reserves somewhat out of US treasuries and somewhat into gold. And think of European and Asian banks benefiting from the lower rates that we've set here, which then trickle out to the rest of the world, and the higher business activity they're experiencing in their regions. So that's a few examples. I wanted to share a specific example of how that's directly impacted our portfolio. So in the international portfolio, we've seen our large cap value and small cap value managers both post some of the best returns across the domestic and international portfolios, which is a pretty big shift from the Mag 7 large cap growth driven stocks that have dominated returns for quite a while. So example is LSV Asset Management. They've been a manager in our international large cap portfolio since 2013. So they're a large cap value manager. That portfolio is up 56% over the last 12 months. They're beating their value benchmark by 13 points. So I point that out because, it's fun to highlight when good things happen. And that's not me patting myself on my back. The credit for that goes to Vince and my predecessor, Starla, who constructed the portfolio the way they did and picked LSV. But I point that out to make the point that the way we structure our portfolio in a very diversified way, and we want broad exposure across growth and value and market caps and regions, because you don't know. It's very difficult to predict what's going to lead the market. I think a year ago, very few people would have said, hey, large cap value international is going to be the best performing asset class in the portfolio. So that's why we maintain those diversified exposures. So when you get these periods of strength, that we have that exposure there and we can participate. One quick point on the macro front. So last month we had a question on consumer debt, or kind of a comment on consumer debt. So I just wanted to highlight some metrics there. So US household debt delinquency rate is 4.8%. That's the highest since 2017. That's been driven by delinquencies and mortgage payments in lower income zip codes and student loan delinquencies. So there was a moratorium on repayment of student loans for a while during the pandemic, and that's been lifted. So we've seen a big jump in student loan delinquencies. Those are at 16.3% right now. Credit card loans, at least 90 days delinquent, rose to 12.7%. That's the highest since 2011. The auto loan delinquency is at 5.2%. That's the highest since 2010. So this is evidence of the K-shaped economy, where higher earners are doing well and benefiting from stock market appreciation, et cetera, and able to absorb the cost of living and affordability challenges. And medium and lower income earners are struggling, and that's an issue. In January, we saw maybe a little bit of a green shoot with the jobs report that came out much stronger than expected and much stronger than we saw through last year. So through last year, on a monthly basis, new jobs added to the US economy was 15,000. And in January, we saw 130,000 added. So that was concentrated in areas like healthcare, construction, professional and business services, with federal payrolls continuing to decline. So that's something that we're watching. It would be great to see the job market improve. It would be great to see a little bit more wage growth to offset cost of living. So we're following those weaker parts of the economy. And next month, I was going to talk about it this month, but with the Supreme Court decision, I pushed it to next month. But next month, I'll talk a bit about AI disruption and how that's impacting the public markets. With that, I'll pass it off to Tom, unless you have any questions on any of that or comments.
Thank you very much. I guess I'd suggest we hold the questions till the briefing is over. Thanks so much.
Yeah.
Yeah, thank you. First off, I knew Graham would do a fantastic job. He's been telling Tara. So what I'm just gonna do is, we'll give a quick overview of how the debt markets reacted to the tariff decision. Bottom line, it was muted just like the equity markets, really across all the major sectors. And when I say sectors, I mean investment grade, high yield, leverage loans, just a few basis points movement at the top index level. So just put some context on how the fixed income market reacted to the tariffs, and then just talk a little about where the debt markets sit in relative to the other market opportunities out there. Just give you a sense of where pricing is and kind of what the expectations are going forward for the remainder of the year. As I said, the reaction to Friday's decision, relatively muted. Just as an example, we'll go to leverage loans, which will be, you would think would react the most. Thursday ended spread of 461. Last night or yesterday ended spread of 466. So 5 basis points, relatively muted. I think as you look forward, so we look at the curve. I went back, looked at the Treasury curve over the year, over the past 6 months, last quarter, last month, and what you do see is a steady steepening in the curve. There's different influences at each end of the curve. On the short end, the market's pricing in 2 more Fed fund rate cuts by year end right now. I think there's an argument emerging out there that with the tariffs being taken off, there's apparently going to be there could be marginally reading on the part of inflation forces. So the market could be pricing in undercutting the pricing, meaning there could be more than 2 cuts going forward. On the long end, and the bigger picture, you have looks like approximately 50-ish billion in revenue loss from the tariffs being taken off. So and this is a global thing, it's not just a US thing. The longer end of the curve is become somewhat more detached from the shorter end of the curve and is becoming more obsessed with fiscal deficits globally. Of course, the US is at the forefront, but it's something that's taking place globally, and it's why you've seen long end rates hold fairly steadily in an environment where you potentially have more volatility, more uncertainty, but longer rates on the as far as treasuries are concerned are kind of holding up there, and there's an expectation that there's going to be an upward bias to those rates gradually, but an upward bias. Where does debt sit relative to other asset classes? Essentially everything's expensive. Credit spreads are tight. We remember Roman mentioned private credit spreads being much tighter over the near term. Everything's tighter, and so just to start with equity, not meaning to pick on your world, but you look at P ratio, it's over 29. The historical average is something around a little below 20, about 19.7. So pretty significantly above its long-term average. When we think about yields, the S&P 500 yield, even after yesterday's sell-off, sits at about 3.4%. The 10-year yield for spot 06 sits above that. Investment grade average yield 4.75. High yield debt yields 7 or 8. Leveraged loan yields are hovering around 8%. And today we're bringing the private credit, our lowest end of the risk spectrum within private credit. It's got the low end of its target range at 10%, which is 200 basis points, which is our target. Hits our target at 200 basis points above leverage, what leverage loans are yield. So in the grand scheme of things, even though everything is much more expensive, the debt market still sit in a pretty competitive space relative to the other asset classes. So tariffs, Greg mentioned marginally lower inflation, could be somewhat supportive to GDP. The big influences, in my opinion, tariffs are somewhat noise. The big influences going forward. The AI CapEx cycle, as I said, significant deficit spending. Short rates anchored lower by the Fed, and the long end becoming more unanchored going forward due to the deteriorating fiscal picture globally. So what do you got? You got strong capital spending and CapEx, and you got a fairly easy money environment. So that's going to be largely supported to the markets, both debt and equity, for the remainder of the year. You've got an election cycle coming up. Nobody's going to want to be cutting spending in that in light of that. So, overall credit spreads are not moving materially right now. With that said, if there are any questions, happy to answer.
Thank you very much for that excellent briefing. Any questions from the council on the briefing? Okay, hearing none, thank you so much.
Thank you.
Let's move on to our performance report. Mr. Carpenito and RBK.
And Mr. Chair, just to let you know, Mr. Carpenito is out sick today and unable to join us, so it'll just be RBK.
Great. Yeah.
Thank you, Mr. Chair. Good morning, everyone. We do have your fourth quarter executive summary, new materials, starting off on page 16. Your asset class directors, done a lot, did a great job of providing an overview of the more near-term macro risks and market events. We'll try to bring 2025 into context and close. I think as you'll see and likely know, 2025 was a standout year for the markets and for the SIC, and so we'll be reporting on that. And as it was alluded to in some of the comments, we've had some very strong returns, and that of course is influencing valuations. You've always been very valuation aware in the way that you deploy capital, which has continued to serve you well. But also has an impact on our forward-looking capital market expectations that we're in the process of finalizing, and very excited to bring you over in the next series of months to discuss strategy and what all that means in terms of portfolio positioning going forward. So if I could move to the next page, page 16, you'll see at the bottom left there a table titled Market Performance. What you'll see there is that all equity markets provided positive returns, not just in Q4, actually Q4 moderated some, but throughout all of 2025. Very strong returns, double digits, really across the globe. And again, as was alluded by your director, we're starting to see a bit of a change in terms of leadership. Before, for a number of years now, it was really just the Mag 7, world stocks, anything tech related, AI related. Started to see a transition out of that more into value oriented strategies, really being the leaders in terms of performance, as well as a rotation into more non-US equities, which have really come out of a 10+ year, really since the great financial crisis, GFC, so call it at this point over 15 years of US equity dominance that is in perhaps the early innings of a change there. Again, you're well positioned for a lot of these changes, given your foresight and the way that you position the portfolio, not just looking in the rearview mirror, but trying to be very proactive in terms of where the market is heading. So you're being served very well by that. But if you're looking at the calendar year to date or the 1 year columns, which in this case are the same since it's year end, you'll see some very strong returns, particularly for the non-US markets. You'll see lots of 30s. So both developed and emerging markets put up over 30% in 2025. And that's a multiple of what we would expect in any given year. So outsized return. Now, of course, the starting point from a valuation perspective relative to US equity was a lot lower, but it's certainly closing the gap somewhat there. I think there was some discussion again, and we've had it in prior months about the US dollar selling off somewhat relative to other currencies, the discussion about that, the deficit, sanctions, which I think made a number of other nations uneasy about holding lots of reserves and looking for alternatives. And we've seen that dollar decline and the very rapid rise in gold as a potential offset. And so that transition has very much boosted those non-US equity, really any asset that is denominated in non-US dollar currency by the time you convert it back. So for example, that 33% or so return that you're seeing for non-US equity in local currency, so just in terms of what actually the earnings generated, was about 21, and then the currency added another 10, 11, 12% on top of that. So you had essentially a double benefit, all things kind of coming together at the same time. And that may very well persist, but clearly an indication of just how impactful that currency movement and I think the general angst about deficit in the US and the availability of US dollar as a reserve currency for the long term, certainly providing some concerns there. Fixed income markets had a good year as well, 7%, not bad, but relative to 33%, maybe less exciting. So, but I am quite pleased to report that really all parts of your portfolio were doing very well. You were getting benefits through the diversification that you have, and all things were contributing in varying degrees. And so there's already some discussion. You can see the yield curve there. Director Lofton alluded to that. The change there, if you're comparing the yellow to the green line, that's 2025 year end versus 2024 year end. You can see that more pronounced shift downward on the low end of the curve as the Fed lowered rates for that year, and less so on the long end for all the reasons that were mentioned. So you can see that shift. And again, your positioning in the portfolio was quite accretive. You've got good positioning in your public fixed income portfolio, and as a result of that, you outperformed the benchmark despite swinging results just for the aggregate index as a whole. So when you take all that together, again, a very good year. You'll see that the land grant put up over 13% for the calendar year, mostly driven by public equities, given those strong results. Probably no surprise there. But again, contributions throughout, even cash, which you may be holding more than you'd like, but is a byproduct of just the strong inflows that you've had, put up 4.5%. And for essentially no risk, 4.5%, it's pretty good, especially as inflation continues to ease. Inflation now starts with a 2. So you're getting at least 1.5% or so of real return, even in the cash that you hold. And I think that's, of course, very important, and something that we'll continue to keep an eye on with the staff and with you to make sure that you're getting a reasonable real rate of return on that as well. So private markets also put up somewhere around 9% across most of the categories: private debt, private equity, the real assets. So contributions everywhere. Everything was accretive. And again, a byproduct of just your forward-looking approach to portfolio positioning, as what was mentioned in some of the intro comments from your directors. So as I said, we are in the final stages of the capital market and asset allocation process. So we'll look forward to bringing you updated expected return and risk expectations for all your funds, and of course for all the asset classes. And so we'll be discussing that in the coming months. I'll turn it over to Marcia and give you more of the highlights of the portfolio.
Thank you.
Thank you. So this report is structured to look at asset allocation first. Asset allocation, biggest driver of return, and then we look at total fund performance or performance of each of the funds, and then we go into the asset class performance. So that's how it's structured. So if we go to page 17, we begin looking at the asset allocation. And this first page, page 17, these three funds make up over 88% of the total fund assets. And these are the only three funds that have interim targets still. And you can see that they're close to their interim targets, but again, it takes a while to fund up the private assets. So you do hold more cash and more fixed income. And your staff looks at this all the time and rebalances. If you go to page 18, just a comment, I want to refer to something your state investment officer said. With the legislative session, we will be probably looking at allocations for some of the funds. The top one on page 18 tax stabilization, there is a chance that might be used. It's liquid, pretty liquid now. You can see it has short-term, low duration and public fixed income. It also has some private debt and private real estate. So just looking at some of the funds that were affected by the legislative session, we'll be working with staff, just reviewing those and see if they're appropriately positioned going forward based on the legislature decided. I would also take you to page 20 and just indicate the Medicaid trust was funded. It was funded in December, and that's the bottom of page 20. So currently in cash, but the 43 million was deposited in December, and it's earned money already being in cash. So more assets there. Next, on page 22, this is looking at the performance for each of the individual funds. If you look down, the quarter was very strong for each of the funds, ranging 2.5% for most funds to 1.5% for the more conservatively managed tax stabilization fund. Looking at calendar year to date, these numbers are quite remarkable. Over 13%, over 12%. The lowest return again was the tax stabilization that returned almost 7% for the year, being more conservatively positioned. Tobacco settlement happened to be the winner at 14.61% for the year, just strong. These are all net of these returns. So good performance, as Matthias referenced, for your portfolios. Page 24, I always like to show this because this is looking at the schedule of investable assets and the top line total fund contributions came in just under $5.5 billion for the calendar year, quite remarkable. You paid out distributions of over $2.6 billion, again, remarkable. And so the net cash flow is at positive 2.8. So enviable numbers, having cash flows coming in. It's not an objective. I'm going to page 26. We show in the quarterly reports, we show you peer information. It's not an objective. It's just information that people like to see, and it's also can be informative. But again, just want to stress, this is not an objective in your investment policy statement. For the land grant, looking at a universe, and this is a broad universe. We don't select this universe. The universe we typically look at is greater than $1 billion. And you can see the highlighted area for the quarter, you ranked in the 30th percentile. Calendar year to date, median at 51st percentile, and then 10-year, again, a median at 47th. So we've discussed this before. And you've experienced this in years past where you were at the top, you were at the bottom, you're at the top, but consistently being above median is a good place to be. And so there's truth in these numbers, and we also compare you to a very broad universe, which has very small funds in it and very large funds. Same information on 27 for severance, but let's go to page 28. And this looks at the total fund for land grant and severance. Land grant is the green triangle that's hidden by its policy benchmark. Oh, the green diamond, excuse me, that's kind of hidden by its policy index, which is the yellow triangle pointing down. But you can see that the land grant follows exactly where you want to fall. Being from Portland, Oregon, we like to say you want to be in the Northwest quadrant. But you fall right in the Northwest quadrant where you have above median return at below median volatility. How do you fall into that? We say the story behind that is diversification. You've been able to capture the upside. In this particular 5-year period on the top left, you compared to median, you had 113% of the median return, and you got there with only 81% of volatility of the median fund. So that's a great place to be. If you look over 10 years, you can't see the green diamond, but it's under that triangle again. You still are in the northwest quadrant there, above median return, below median risk, but you've moved up. Again, we think the biggest driver of that is your diversification of the portfolio has served you well. Something I don't typically go over on the bottom of page 28, this is looking at your allocation by asset class compared to peers. And the only thing I want to point out here, if you look at this second, global ex-US equity, well, global ex-US equity, what's that, non-US equity? You can see that you're above median in your allocation. In the past few years, that's been kind of a headwind for you. When stuck with, it's certainly been a tailwind. Matthias gave you those numbers. And again, you're ranked in the 25th percentile in your allocation to non-US equity, and that's been a great place for you to be. The next page is on page 29 through 30. This is looking at the building blocks of your asset allocation, each of the asset class composites. Looking at US equity, I would just point out, yes, you underperformed slightly for the year, but I will have to say, compared to what we've seen for a lot of other plans, underperforming the benchmark by 24 basis points. Net of fees. This has been a market, 2025 was a market where, if you probably read this in the Wall Street, that less than 30%, less than 25% of active managers actually outperformed their benchmarks in 2025. You think about that, it was still a period where it was very narrow. The Magnificent Seven were still hanging on. So that was a period where you did quite well in a very narrow market. Non-US equity, you see some underperformance there. But again, looking at the 3-year net of fees right at your benchmark, your public market fixed income has done quite well, outperforming in each time period shown. And then cash, as Matthias said, nothing wrong with 4.5% as a holding place when you have those cash flows coming in. The next page 25, is looking at your private assets, and I believe you're going to be receiving reports from today, or you have that, so I'm not going to go into that. This is time weighted. You'll see both time weighted, and you'll also see IRRs in those reports. I do want to point out, though, that other private equity, that includes what used to be the New Mexico private equity legacy, but also the strategic venture capital. Those are going to be split out soon. So you can see those separately, which we think is very important to do. And I also want to remind that on the ETIs, the economically targeted investments, that's only 0.37% of your total assets. And that's all right now in the severance tax fund. So again, a very low allocation of economically targeted. With that, we can talk about this for hours, but we'll take any questions you have, and thanks for your time.
Thank you very much. Any questions for RVK on our 2025 performance report?
Thank
Any questions on the phone? I just have a comment. I just think it's noteworthy and commendable, that we achieved, the same return as the median plan, captured so much upside compared to the S&P, despite this wall of cash that's been coming in that we've had to, that's been sitting in cash and bonds, and speaks to, the international exposure and diversification that we had. And so commend the team and our consultants, and I think we can feel really good about 2025.
You should.
Great. Well, thank you so much.
Thank you.
Moving on to our portfolio recommendations and update, I will provide the investment committee report. We met as the investment committee last week. All of the members were present. The treasurer also joined us for a portion of the meeting. We reviewed the voting items that we have before us today. We did agree to recommend each of those items to the council for approval today. In and I think those were all unanimous with the exception of one, which was the Eagle Fund, where I think Member Roman just wanted to continue to consider that item ahead of today's meeting. But that's my report. Happy to answer any questions. Otherwise, would suggest we move on to item 3B, which is the Strategic Venture Capital Program, a SIC Capital Origin LP reallocation.
Good morning, everyone. In November 2025, the SIC approved a commitment of $15 million to a group called SIC Capital. If you recall, Hank V. Hill, who grew up in New Mexico and his family has origins in the state. After the approval, they decided to participate in the SBIC Critical Technologies Program, which was set up by the Small Business Administration and the Pentagon to spur investment in 14 critical technologies that are important to national security. If you recall, America's Frontier Fund was one of the first recipients of that program. And so there's, given this program invests in a lot of managers that are investing in national security and all the critical technologies that relate to that. Not as surprised they look to participate in that program. The good thing from the SIC perspective, I think, is it's a program that gives their portfolio companies an opportunity to take advantage of non-dilutive capital, whether that's government contracts or other types of appropriations. So there's a strategic benefit for their portfolio companies. They're recommending that we're recommending that we reallocate part of the original commitment, $6 million, to the SBIC fund. Not all their investment activities qualify for the program because they do make investments in other sectors and outside the country. So, but hopefully not too controversial, and we're recommending that reallocation. If you have any questions.
Very much. Any questions on the reallocation for the SIC Capital Origin funds? Hearing none, is there a motion on this matter?
Mr. Chair, based on the recommendations of the Council Investment Committee, Advisor Mercer and SIC staff and general fiduciary oversight of RVK, I move that the State Investment Council approve the reallocation of the council's previous $15 million commitment to SIC Capital Origin in two fund commitments, $9 million to a SIC Capital Origin LP and $6 million to SIC Capital Origin SBIC LP, as memorialized in today's meeting materials and as discussed by the council today.
Okay, motion by Member Tejas.
I
Is
second.
there a second by Member Allen? Could we have a roll call vote, please?
Deputy Secretary Wayne Province. Nick Tejas. Yes. Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Summer. Mary Roman.
Yes.
I think Kurt stepped out, 7 in the affirmative, motion passes.
Okay, thank you very much. Let's move on to item 3C, Kinderhook Strategic Opportunities Fund 1.
Great, thank you, Mr. Chair. I'll give an introduction to Kinderhook and then we'll hear more from the firm itself. So Kinderhook's an existing relationship in the national program. The SIC approved a $100 million commitment to Kinderhook Industries 8 in January 2024. And while it's still early, that fund is just under a 2x net multiple and a pretty high IRR because of the newness of the fund as of September 30th, 2025. Kinderhook really manages middle market buyout funds targeting North American based companies in 3 sectors: light manufacturing and automotive, healthcare services, and industrial and environmental services. The Strategic Opportunities Fund that we're talking about today is a similar strategy to that flagship Kinderhook fund, but they target smaller investments of less than $100 million. And we like this fund as an opportunity to expand the relationship with Kinderhook You're getting exposure to smaller companies and it further diversifies the overall portfolio. Kinderhook's been led by 3 managing directors since 2003. We have Chris McCulloch here with us today. One of the managing directors is in a chairman role and the other 2 are active on the investment committee. The firm has a deep bench of 5 additional managing directors with an average tenure of 18 years across the group. The firm's really built a strong culture, which has led to limited turnover over the years. They've had really low senior level departures since the firm was founded. In addition to the industry expertise the firm's built up, the strategy is really focused on improving companies through the control buyout focus. You can see this with an emphasis on improving portfolio companies. A big part of this strategy is building through add-on acquisitions, but they also have a team of over 90 operating partners who can assist with a number of different initiatives, such as optimizing business processes or expanding into new geographies. They tend to source companies away from competitive auctions and tend to use less leverage as part of their strategy. From a track record perspective, I mean, it's been strong across the previous funds. In aggregate, they've generated a 19% net IRR and a 1.8 times net multiple. Most of the performance measures rank above median when compared to the buyout benchmark. And that is comparing against benchmarks where you had a lot of technology as well and technology buyout funds that deliver high returns. You know, we also like that this consistent performance is seen across multiple economic cycles, which is a positive as well. You know, from alignment perspective, the firm is making a sizable commitment to this fund too, which increases alignment with limited partners. We're recommending a $100 million commitment to the fund. And Mr. Chair, I'll turn the time over now to Chris Pollock, who from Kinderhook, for a little bit more about his firm and fund.
Wonderful. Thank you, Richard. Mr. Chairman, thank you for having me. I appreciate this opportunity. I'll keep it brief because Richard took most of my talking points. I think the things that we're proud of that we've created in our firm touch on what I kind of think was the 3 legs of the stool of private equity. And our industry is now mature. There's thousands of private equity firms. I think they've come under a little bit of tougher times of late. But one thing that we've done very consistently over time is try to say, how do we build an organization that, because you are making a 10-year commitment to funds like private equity funds, how do we generate consistent returns over time? And we think it comes to the expertise and what we think was the 3 legs of the stool. So it's the general partnership, it's the operating strategy, and it's the deal flow. And all private equity firms jump into those 3 areas. And for us, it's really about the differentiation of each of those. And Richard touched on the key points, but we've built the team internally. So we've built our organization from within. Everyone's been hired as an associate and been promoted within our organization over time. And we have had a balanced compensation model that rewards fund performance, not individual performance. And therefore, we've been able to generate consistent returns and can build our team without turnover. So in an industry that's had rampant turnover, as an employee in the industry 25 years ago, I lived part of that. We've had no unforced turnover of our VPs and above for nearly 20 years. So we're very proud of that and think that gives consistency going into the future because, of course, you're buying a new set of assets that will generate over the next 24 to 36 months. Second is deal flow. And ultimately, deal flow is hard to find. It comes through relationships and knowledge. And we focused on the 3 core sectors that Richard mentioned and stuck with them. We thought they were generally non-correlated in the US market. Because we're such large LPs in our funds and have been for over 20 years, we didn't want to be in a single industry, but we chose 3 segments of the US healthcare or US economy that we thought were non-correlated, and that served us well and we've stuck with them. So our industry expertise and knowledge, and I would say humbly in the environmental services space in particular, we might be the longest standing in one of the best investor in environmental services in the United States. In our healthcare services environment, we are building companies focused on patient care and patient access. We've done very well in these segments, as well as in the light manufacturing and automotive segment. And then last is operations. And it really comes back to working with people and allowing executives to build their teams, invest in people, and be able to go through the adversity of building a business. It's not linear, and it takes wherewithal. And our job is to support the talent. We're not the talent. The talent is the CEOs and executives who run our businesses. And that relationship and respect for the operating strategy, I think, has given us high level of performance within our team as we reward people for their success. And so those things have created, as Richard said, nearly 20% net IRRs over 20 years, and each of our funds has generated at or above 2 times net MOICs, and that's what we look to do in the future. So appreciate your time. Happy to answer any questions for the committee.
Okay, thank you very much. Any questions regarding the Kinderhook opportunity?
Mr. Chairman, I have a question.
Yep, Member O'Donnell, I believe that is on the phone.
It is. Thank you. And welcome to New Mexico. I just have a question about, well, let me preface this. We just came out of a state legislative session where there was a huge focus on healthcare, in particular, rural healthcare and access. So your investments in that space are of great interest and very relevant to some of the questions that are being posed in New Mexico right now. One of the major issues that was discussed repeatedly in the context of a variety of different pieces of legislation was the potential for private equity investments in New Mexico's very fragile and limited healthcare infrastructure, particularly in rural areas. And there seemed to be I don't know if it's consensus, but certainly a large number of policymakers voicing a great deal of concern about private equity ownership of healthcare assets. And so I guess that causes me as a member of this council to think, how do we as council members ensure that we are not, or the state of New Mexico is not investing in and potentially profiting from practices in other states that we would not want happening in New Mexico. So I guess my question really is, how do you differentiate yourself? If I have to go back and talk to people who are very concerned about the presence of private equity in New Mexico, and understand you're not invested in New Mexico right now, but who are interested and concerned about this, how do I say, hey, the State Investment Council is not investing in those sorts of practices. Rather, the investment we just made in Kinderhook is they abide by certain principles in their activities within the healthcare space that differentiates them from some of these other private equity firms about which a lot of folks are expressing a lot of concern.
I'm not sure the specific concerns, but I would say what we've focused on, and this is my area of oversight within Kinderhook is healthcare services, is patient access and health outcomes. And those standards, and we participate in a fair amount of government programs. So those, if you think about the standards, are set by the government. So STAR scores in Medicare Advantage plans, HEDIS scores in a lot of state Medicaid programs. So those are the benchmarks that healthcare payers, providers, and different caregivers are asked to represent. And the businesses that we have owned and built, and some in our current portfolio, just a few highlights. So we own a business called Medical Card Systems on the island of Puerto Rico. When we acquired the business 4 years ago, it was a 4-star Medicare Advantage plan. And it was about the 3rd largest on the island of Puerto Rico. Today, it's the largest Medicare Advantage plan on the island of Puerto Rico. It's a 5-star health plan. It's the largest 5-star Medicare Advantage plan in the United States of America, which is breakdown. So it doesn't mean we're the most members. We're actually the 10th largest Medicare Advantage plan in the United States of America, United Healthcare being the largest. So quality matters. Investing and creating access on the island of Puerto Rico matters. We empower providers to give patient care. We provide benefit design and oversight that allows hospitals and communities to grow. We recently, in an investment that you all have invested in our 8th fund, a company called Steward Healthcare, the largest healthcare bankruptcy in the United States of America. A lot of bad press around this asset, was owned by a gentleman named Ralph De La Torre. Massachusetts went bankrupt. We decided to purchase the positions out of that bankrupt estate and reinvest in those communities. So we work closely with the Health Policy Commission in the state of Massachusetts, who approved our acquisition And we have maintained a strong relationship. We're in multiple states, including Arizona, Tennessee, and New Massachusetts, as well as some in Texas. But Massachusetts is our largest presence because what we were able to help the state see is without our investment, you were not going to continue to have access to low income neighborhoods. You're not going to have access. We provide some of the largest and most cost efficient Medicaid access in the state of Massachusetts. And so investment into these communities, investing into these practices actually strengthens access, not the opposite. And so I can't speak to the specifics, and I know it's, you know, sometimes convenient to point a finger, but what we found and what our mission is to provide great access, great patient care, which results in growth, jobs, and building communities. And so that's how we think about it, and it's served our investors well as well, because ultimately that's part of being an investor.
Just to thank you for that, by the way. Just to follow up, are there metrics you use to measure your net impact on access? Understanding that obviously the bankruptcy of a large, a clinical, bankruptcy of an asset within the clinical delivery system is going to impact access, and thus your purchase of it. Setting that aside, are there metrics you use to measure your net impact on overall access?
I cannot point to a specific metric on access. I can point to the HEDIS and STAR scores that we achieve for our payment partners and our government payment partners. So that's largely what I focus on. I could get you data on the number of additional access sites that we've opened and the additional doctors we've moved into our networks. So I think that would be the closest thing that I could probably find for you to specifically look at access under assets that we own.
All right. Well, thank you.
Thank you very much. Any additional questions on Kinderhook? Hearing none, is there a motion on Kinderhook?
Mr. Chair, based on the recommendations of the Council Investment Committee, Advisor Mercer, SIC staff and general fiduciary oversight from RBK, I move that the State Investment Council approve a commitment of up to $100 million to Kinderhook Strategic Opportunities Fund 1 LP, subject to and contingent to New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Okay, Member Tejas has made a motion. Is there a second? Second from Secretary Probst. Is there any discussion? Hearing none, let's have a roll call vote.
DFA Secretary Wayne Probst.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Beeman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Abstain and to explain.
Kurt Summer. Mary Run.
Yes.
6 in the affirmative, motion passed.
Okay, thank you, Member Sanchez.
Yeah, I have a possible conflict of interest, but very happy to see more money going into healthcare in any way we can get that there. Thank you.
Thank you very much. Thank you for being here.
Thank you very much, we appreciate it.
Okay, let's move on to item 3D, which is the Nieberger Berman Eagle Fund.
Thank you, Mr. Chair, and members of the council. SIC staff, in consultation with Nikita, recommends a commitment of up to $300 million to Neuberger Berman, called NB Eagle. This allocation aligns with private debt's objectives generating attractive risk-adjusted returns, enhancing collateral diversification, and prioritizing yield as a primary driver of private debt's total return. Indy Eagle is an evergreen structure. They have discounted management fees. For us, it's 30 basis points. Apologies, public session. Probably should get that quiet, but it's out there now. Their targeted net IRR return is 10 to 13%. And it makes a compelling risk-adjusted opportunity within the private debt portfolio. The fund has a conservative investment approach in staff's opinion, strong sourcing advantage, and a robust operational framework. In staff's opinion, positions it to be capable of delivering stable income and long-term value for SIC private debt portfolio. This is a new relationship for private debt, but it is an existing relationship for SIC in terms of the fact that the real estate allocation has commitments to 4 vintages, that easy for me to say, to Almanac Realty Securities, which is owned by Berman. I just want to highlight a couple of things before I turn it over to Mary, and then Susan Kasser and Dan Ransenberg from Neuberger Berman. Just want to highlight primary yield as a return driver, 10 to 13% net, top of the capital structure. And one thing I failed to mention, we can maybe get more into this when we get into the private debt performance review. But at the high level, when you look at average spreads, things look somewhat stable. But when you go underneath, when you dig down into it, there's quite a bit of dispersion out there, right? So the manager matters, the underwriting matters. There's dispersion in returns, dispersion in the opportunities that are available. And I just wanted to point out, so just yesterday, I received a consulting firm out there, Axia, one of the larger consulting firms out there. They came out with their private debt report for end of 2025. For the period from 2020 to 2025, all the private debt direct lending vintages, when you look at leverage, detachment leverage from 4 times to above 6 times, the losses range from 0.29% up to 0.61%. So this is the same period over which Ms. Kasser's group would have been originating direct lending loans. What were your losses over that time?
Thank you for asking. 1/100 of 1%.
Right. So manager underwriting matters. And so with that, I'm going to turn it over to
Sounds great. Thank you, Tom, and thank you to the trustees. I'm going to quickly walk through a brief overview of the strategies, and then consistent with how we typically present, I'll walk through what we identify as the strengths as well as the concerns and associated mitigants with those. What I'm not going to focus on, and what we've asked Susan and team to discuss, is the broader question that I think is on the table today, which is the impact of AI on private credit and on direct lending, particularly, right? I think a month ago, if we were having this conversation, this probably would have been described as a very plain vanilla, no offense, direct lending strategy. We would have talked about the very low loss rate, as Tom has already referenced, the very attractive yield in the portfolio, and highlighted some of the key high level portfolio characteristics. But obviously the world is evolving, and it's evolving very, very quickly. So I think it's great that we're joined today by the head of the the private debt program and the lead portfolio manager for this strategy to really share some real time thoughts. But first, NB Eagle is a middle market direct lending strategy that is focused on sponsor backed lending. The strategy is focused on the core segment of the middle market defined in terms of capitalization. What that means is this strategy has an average EBITDA at time of entry of roughly $80 million. It's focused at the top of the capital structure, with over 95% of loans being either first lien or unitranche. Neuberger is the lead or co-lead also on 95% of deals. Why that's important is because that means that they're able to drive the structuring and the negotiation of the terms. They write the covenants, which is another way to say that. The portfolio is highly diverse. When it's ramped, we expect over 100 line items. So in the event that there's any individual credit impairment, it should not have an overly negative impact on the portfolio. It's also very diverse across sectors and across strategies. Obviously, there's a strong focus today on software, but many segments of the market are being impacted by AI. And again, Susan will speak to that more directly. The portfolio that we're presenting today is NB Eagle, which is a hybrid evergreen fund, and it is currently ramping. So today it is roughly 40% deployed. If you move forward with a commitment, the denominator would change and it would be roughly 30% invested. Why that's good is effectively there are no problem credits in the portfolio, and Susan will share again her thoughts in terms of the go forward. The losses have already been highlighted over the over Susan's track record. Less than 2% or 2 basis points, excuse me, a big difference between 2% and 2 basis points, 2 basis points of annualized defaults, less than 1 basis point of losses. So effectively 0 losses. On NB Eagle, and this is a moving target, it changes all the time, but the gross cash yield on a levered basis, and this is a levered strategy and employs 1-to-1 fund level debt on a debt to equity basis, is 13.4%. So a very attractive gross yield. So to quickly walk through why we like this strategy, direct lending, particularly the sponsor backed space, everyone knows it is very competitive. A very competitive market. What is incredibly important to the direct lending space, because as we know, again, there's no upside in direct lending. Direct lending is about SOFR plus a spread plus some fees, prepayments, OID. You subtract out the losses, you subtract out the fees, which is why fees matter a lot, and then you apply leverage. So making sure that you're engaging with a manager who has strong underwriting capabilities, very low losses. You have, we've been able to negotiate through Makita aggregation as well as through your size, some what we view as highly favorable economics, but most importantly, partnering with a manager that has incredibly strong underwriting capabilities. And I think that's illustrated by the track record of the team. And then also what's incredibly important is the ability to say no. So you need to have everyone's seen managers pitch books with the proverbial funnel, right? You need a very, very large funnel in the debt space and in middle market direct lending, in sponsor backed middle market direct lending. Most notably, more often than not, managers who will come and pitch and talk about their strategies in this space will talk about the depth of their relationships. Well, relationships are clearly important. They're hard to quantify. What we can quantify and what Susan can outline is the depth of the Neuberger Berman platform. So when she left Carlisle to start the platform at Neuberger Berman, one of the things that very much appealed to her was the other side of the house at Neuberger Berman. So Neuberger Berman probably is a name that people know given its breadth as a multi-asset class, broad-based manager, but they're actually one of the biggest investors in private equity. So they're not a private equity manager. They, I think to borrow their verbiage, support the private equity ecosystem, which means they're an LP of private equity GPs. And I think everyone around this table appreciates that when you're a client, you can say no.
And because you can say no, and the GPs still need to come back to you. So that's incredibly important in terms of deal flow, and it allows her to her and her team to be very, very selective in moving forward with opportunities. And truly, that is differentiated in the marketplace. There really are very, very few managers that have that seat and that seat at the table. And it's one of the reasons that Makita look to underwrite them. Another reason why we were comfortable with Newburger Berman, why we have a lot of client exposure with them, is because they're not the biggest, but they're not the smallest either. So they occupy what we view as a sweet spot in the private debt ecosystem, I guess you could say, where they're big enough to control deals. But they're not so big that they need to take every deal that comes out there. And then the third point, and this is what really ties into what's happening today in the marketplace, is they do not have what's called, you may have been reading the Wall Street Journal and the FT recently, the semi-liquid space. So the semi-liquid space is this kind of like new segment of the private debt market, which is catering to more of the mass affluent. In part, it's doing it through a structure that's been around for quite some time, the BDC market, that's targeted more to the retail market space. But then there's also a growing segment of the market, the interval market. And so Newburger Berman, they don't have a product in that space. Why that space can be challenging for managers is one of the things is that they don't have the ability to control deal flow as much as they do on the institutional space. As you know, one of the key benefits of the private markets is the GP has the ability and the discretion and the duty to deploy capital when they view it as attractive. And so not having that is very, very beneficial from our perspective. We would also highlight the portfolio that you would be investing into. I'll let Susan go into greater detail around that, but those are all of the reasons, coupled with the fees, which Tom disclosed, that are all very attractive from our perspective. So what are some things we don't like? There always are things that, are points of concern. One is a technical component that ties to how carry is calculated. This is a hybrid evergreen fund, and it's always a challenge with that type of structure, in terms of how you crystallize the incentive fee. So, effectively, one of the things that's very important is that Susan doesn't have any losses in this portfolio. And, her track record speaks to that, but you can drill her more on that. The team is also small relative to some of the larger players in the space, if you look at it on an isolated investment professional basis. But it comes back to the fact that they are part of this broader ecosystem that's important to recognize. And it also comes back to the point that one of the things that I take a lot of comfort in is the fact that it is Susan who is signing off on every deal. She hasn't decided to grow her portfolio so that she's on the road all the time doing pitches like this, or pitching to other constituents in the market. So she signs off on every deal, and she's one of the best from our perspective in this market. So with that, I'm going to pause. Happy to turn it over to Newburger now, or take questions, whatever you would prefer.
Great. Thank you so much. I think we should hear from Newburger and then go to questions. Thank you so much for being here.
Thank you. Thank you all. Yeah. We appreciate it. My name is Dan Ratzberg, so I lead the client advisor for you and your team. So basically, to bring Newburger to your organization, Susan leads the private debt. First of all, thank you. Thank you for the time today. Thank you for the investment in the Almanac. We're greatly appreciative. I'll spend 1 minute on Newburger. Happy to take any questions, but I know the goal here is on Susan and her team. But the firm exists to deliver compelling long-term returns. That's really it. That's our only business. The returns are across a number of different asset classes that were mentioned: public equities, public fixed income, private markets. So it's what that means for you, a very diversified business. What that means is a stable business for Susan. What that means is a lot of resources for Susan to leverage over time. So the long-term return, and then the second piece is long-term. So a key piece here is that we're fully employee owned. We have no shareholders to report to on short-term basis. So we're fully aligned with your long-term, you have long-term goals. We're aligned with that long-term vision. I can take any questions if there's any on the firm, but really I know the goal is for Susan to get into her piece.
Great, yeah, we can hold questions till the end, thank you.
Okay, thank you all for the time today and the potential to work together. There's very little to add. It was very well covered by Tom and Mary and by my colleague Dan. I do want to emphasize a few points that were made. First and foremost, this is a senior secured investment strategy. The purpose that it serves in your portfolio is, as Mary said, to be plain vanilla, to be boring, not to have volatility, not to have losses, not to have problems. It is not trying to maximize return. It is, however, committed to delivering the return through contractual cash coupon that we earn quarterly from a very diversified portfolio of loans and that we pass on to you quarterly. We are maniacally focused on capital preservation above all. That is why the statistic that we talk about the most is the 100% losses since inception, which is more than 13 years ago and more than $28 billion ago. And it's the same team over that time. We believe that if we are maniacally focused on capital preservation, we will be able to help you fulfill your mission for your beneficiaries. I will also reiterate an important point, which is many of the managers are very focused on working for both the ordinary investor, the retail investor, as well as the institutional investor. Neuberger as a platform helps both individual investors and institutional investors achieve their goals. The private debt program at Neuberger is 99% institutional investors. So if we did earn your trust and commitment today, you would be in the company of other institutional investors just like yourselves. With that, maybe I'll see if there's questions.
Great, thank you so much. Any questions on Neuberger Berman Eagle Fund? I did have a question, just relative to the other funds that you manage in the private debt strategy. So how do you decide, which loans go into which funds, and sort of how do you think about this fund relative to, the others that you manage?
That's an excellent question. Thank you. I should have brought that up. It's a very simple answer. There's no differentiation and no cherry picking. So all funds that are open participate alongside each other in all new investment opportunities. So Eagle does not perfectly mirror an older fund, but it would mirror any other fund going forward. We are very careful to distinguish between new investment opportunities and support capital for an underperforming business. Support capital for an underperforming business is not distributed across the program. That stays with the funds that already have exposure.
Got it. Okay, thank you. And then one more question, just on the margin leverage that you use, could you help us understand sort of how that's structured and like what would constitute an event of default under that?
Another very good question. We describe our credit facilities as hard to use, hard to lose. They are actually long-term bilateral programs with investment banks. Sorry, I shouldn't say investment banks, commercial banks. Our largest counterpart lender is Sumitomo Bank. They re-underwrite every loan that we put into the portfolio and decide individually whether they will or will not extend credit on that loan. So the amount of leverage in this portfolio could be as high as $1 of debt to $1 of equity. It cannot be higher. It could be lower. That's what makes it hard to use because they have to re-underwrite everything that you're underwriting. They do not take it on blind trust or blind faith. What makes it hard to lose is that the agreement is long-term. The maximum amount of capital is secured. The pricing on the capital is secured. And the event in which case they could ask for repayments is also secured. And it is contingent on underperformance across the entire portfolio. The portfolio, as Mary had mentioned, is extremely diversified. When it ramps, it will have well over 100 names. A maximum position is 2%. In our history using leverage, which goes back to pre-pandemic, we have never had to pay down a single dollar to our lenders. Which is another reason why the low default and low losses are so important in this asset class.
Gotcha. So based on loan performance, as opposed to like any mark to market.
That's right. Thank you for bringing that up. There's specifically no trigger on mark to market. We would characterize mark to market in a leverage facility as making it easy to use, but also easy to lose.
Got it. Thank you. Any additional questions on Newburgh, Berman, Eagle?
I think maybe I have a couple.
Tays?
We discussed a bit earlier, the issue of, tight credit spreads and things like that. How are you factoring that into, your investment decisions and how's that impacting you currently?
So, Tom presented to you the range of target returns that you are evaluating us on. If we see an opportunity that has a return below that threshold, and it's simple to gauge return, it's the yield on the loan that you're making, then we cannot make the loan, right? So we're not here to underperform the target. Once you know that the loan is within that range, the most important thing to us is capital preservation. How many degrees of margin of safety do we have in our reasoned belief and assessment that the loan will pay off in full and that the coupon is secure for the duration of the loan? If we do not have that belief with multiple margin of safety, we cannot proceed. Once you do those two things, the returns do tend to take care of themselves because also, as Tom and Mary discussed, this is a relatively simple asset class to assess and evaluate. What is the contractual coupon in your portfolio? Are you getting paid that coupon in full? In the case of Eagle, you 100% are. Are there any losses that we need to subtract? At this point, no. Again, our track record is almost zero for losses, less the fees, which are a favorable assist in the case of you as an investor. Those are your final returns. So if spreads compress an enormous amount, then it's possible that we would not be able to perform our duties and we would need to come back to you and speak with you again.
And if I can interject here, I think a key point with Eagle's position as either the unitranche provider or the lead, writing the covenants, that is, in my mind, the ability to write the covenants to define what the underlying terms are. So there's a lot of leeway. Ms. Tays, I believe your accounting background, is that right? I mean, you understand that essentially everything in accounting, whether it's revenue recognition, expense recognition, how you define cash, all that, it's all subjective. And the ability to write covenants, strong covenants, specific covenants, that is in preventing losses, that's probably one of the biggest keys on the lending side. And the fact that somebody can be in that first position and write those covenants, it's a big protective against losses.
And just one quick point that I would add in terms of kind of thinking about like the targeted return. There's both an asset as well as the liability side to this strategy, right? So the asset side, those are the loans. That's what Susan's doing. But this is also a levered strategy. So that's the liability side. So as kind of like base rates go down, the cost of financing goes down. So it's
there's not a mismatch.
Okay. Great. And then I just had to ask, yesterday, there was a big sell-off in the financial sector that led to a pretty big drop in the stock market. And it was based upon a report that came out that had to do with AI risks and things like that. Does that affect you all in terms of your business? And how do you kind of think through that situation where AI is ever present, but there's a lot of uncertainty around it?
I think you put that very well, right? AI is both ever present and there's a lot of uncertainty around it. So let's talk about the sell-off that you've seen. There's three components that we need to think about with that sell-off, only one of which is actually directly AI related. So the first one is that there could be a sell-off at all. And that's because these vehicles that they're talking about are publicly traded. So they're taking illiquid assets, they're taking private loans, and they're putting them in a vehicle that trades like a stock. And as we all know, in the stock market, If you're worried about something, the best thing to do probably is to sell first and ask the questions or get the full answers to your questions later. That's not relevant to us because we don't manage public vehicles. So not only would you be investing in Eagle, a private vehicle, all of our other vehicles are also private. So there's no part of our private debt program that is sensitive to the let's sell first and get answers to our questions later. The second part is fears around the mismatch of long-term investments, private loans, private equity, like Kinderhook was doing, in marketed to investors that could have a short time horizon. So institutional investors like yourselves, you're very sophisticated around not just your risk budgeting, but your liquidity budgeting. When you make an illiquid investment, you understand how long it will be outstanding. When you make liquid investments, you understand how long those will be outstanding. That is not always true for individual investors. And so much of the fear described in those articles have to do with investors wanting liquidity and having concerns about a fundamentally illiquid investment. So again, a mismatch on liquidity. Not an issue here because we are investing on behalf of institutional investors like yourselves who are very sophisticated around illiquidity. So last but not least is AI, right? What will AI do to investment portfolios? And your point about pervasiveness is very true. So what will AI do to every industry, not just software? What will AI do to private credit, but also liquid credit and also public stocks? So what I would say is, of course, we are assessing our portfolio based on AI risk. Of course, we are assessing every possible new investment that we're looking at with AI risk. There's a lot of unknowns, so we're doing the best that we can, and you'll have to judge us better in a year, 2 years, 3 years, 5 years. But one thing that is comforting, and again, this is not how we underwrite fundamentally, but if the business starts to underperform because of AI or anything else, a recession, tariffs, loss of a customer, it's important to remember that this is a diversified portfolio of senior secured loans. The cash equity below our loan is generally 2/3 of the value of the business. So think of what would have to happen to a business for its value to decline by more than 2/3. Until the value declines by more than 2/3, our loan, your investment, if you choose to proceed with us, is not impaired. Now, let me give you an example of a specific software company that is in our portfolio, and we could think together how high the risk is for AI. So this has been publicly announced, so I can name the company. It's called Jeppesen. Jeppesen is the software that underlies all the flight information and data tracking for pilots. A plane does not take off without the Jeppesen software. It has 80% market share globally. The reason that it's not 100% is that there is one other provider that has the leading market share in Europe. So if you assess in the United States, Jeppesen is even more dominant than 80%. Is it possible that AI will enhance this software over time? 100%. In fact, it owns all of its data. It is in the best position to use AI to enhance its product. Do I think that a new upstart built by some AI functionality is going to displace Jeppesen? No, I do not. But it is a software business.
Well, thank you, Mr. Chair. Thank you for the thoughtful answers.
Thank you. Any additional questions on Newburgh Berman Eagle Fund? Hearing none, I'm happy to make this motion based on the recommendation of the Council Investment Committee, Advisor Mercer, SIC staff, and the General Fiduciary Oversight of RBK. I move that the State Investment Council approve a commitment of up to $300 million to Newburgh Berman Eagle Fund LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Mr. Chair, you said Mercer, not Nikita. I don't know if that makes a difference.
Apologies, yeah, but I think the sheet is wrong, yep. So let the record reflect that Makita is the advisor on this commitment.
Second.
Second, Member Sanchez, could we, any discussion on the motion? Hearing none, could we have a roll call vote, please?
DFA Secretary Wayne Pops. Yes. Nick Tess.
Yes.
Catherine Allen.
Yes.
John Bingham.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Summer.
Yes.
And Mary Roman.
Abstain.
That's 7 in the affirmative. Motion passed.
Okay, thank you so much for coming to New Mexico. All right, that concludes our voting items on our portfolio recommendations. We will now move to our performance reviews for the third quarter. And I would just suggest we maybe try to keep these presentations brief, maybe 5 minutes. And people can obviously raise questions. Let's begin with our private debt, DMR with Director Waffle.
Thank you, Mr. Chair. I will keep it very brief. I just want to really mention that, we had a committee meeting, I think it was maybe back in October, where we went through what we're trying to do on the private debt portfolio in terms of diversifying the underlying exposures. From a programmatic standpoint, as Greg said earlier on the public equity side, from a programmatic standpoint, we don't know the outlook for certain macro conditions, certain macro moves. So we're trying to keep a certain amount of programmatic dispersion in the portfolio, collateral, strategy type. But where we can add value, first and foremost, fees. Secondly, we can add value through bringing managers to you that we think are the best in the business in terms of underwriting. Other sort of moves that we can take under the hood. Bertay, you asked about declining spreads on the private credit side. So one of the things that we're doing on the direct lending side, you're seeing us bring you managers that lend to larger companies that have more diversified financial sources, have more diversified businesses. That's frankly in the direct lending side, how we're reacting to the fact that credit spreads are tighter. It does leave less room. And this is our way of leaning into more resilience going forward. Now, pat ourselves on the back a little bit. 4 years ago when I started, we've probably been pitched on public BDCs, investing in public BDCs almost monthly since then. From the get-go, we understood that the asset liability mismatch, you've got short-term capital providers in terms of retail, so you're investing in long-term assets, was a structural risk. So we purposely avoided investing in public credit BDCs. So there are a number of things structurally that we've tried to do to make the portfolio resilient and aside from programmatic diversification, to add value where we can for private debt or public and private debt's frankly role in this portfolio, which is to be there when everything else is going terribly. So with that, I'm going to turn it over to Mary.
Great, thank you, Tom. Chair Bingham, I'll keep my comments very, very brief. We did modestly restructure this report this quarter, so hopefully it's more targeted and we'll make the presentation more succinct. So drawing your attention to page 219 of the materials, what we've done is we've broken out performance with respect to commitments made in 2023 and thereafter, so that's consistent with the restructuring. Since that time period, the private debt program has generated a net IRR of 13.8%. So since the restructuring, 13.8%. Commitments that were made prior to that have generated a since inception IRR of 6.1%. So a very, very meaningful difference. That's why you'll see at the bottom of the page when we present the IRR since inception, you have a since inception IRR of 6.5%. So again, almost all of that is attributable to the performance pre-2002. So as a reminder, in 2025, in our report, this is a report as of September 30th. All of these reports are lagged, consistent with private markets. The SIC had approved 1.7 billion in private credit. So in total, you have 66 commitments. You've done 16, or I'm sorry, screen is too small. 10.5 billion of commitments, and you have a market value of 5.5 billion. Currently, one of the meaningful changes that we made in the performance report is on the next page, where we included a value bridge. I'd like to highlight some of the reports that Mercer did. We thought that's a great addition, and we wanted to copy that. So hopefully this provides more granularity, so you can better appreciate the contributions and distributions as well as the net gains, consistent with what Tom has highlighted. Nearly all of the increase in value was attributable to the yield of the program, as one would expect from private debt, rather than appreciation across the program. 51 funds reported positive returns and net gains in 6.6, and those funds are all in the legacy part of the program, have net losses. So across all funds, the portfolio experienced roughly $140 million of net gains in the quarter. So with that, we have significantly more detail in the program, and I'm happy to address any questions, but hopefully that gives you the key points for the quarter.
Thank you very much. Are there any questions on the private debt PMR? Hearing none, thank you. Let's move on to our national private equity PMO with Director Cassidy.
Thank you, Mr. Chair. I'm just going to go right into it since first is in Los Angeles. We're going to talk about the Q3 2025 performance report today. And I'm going to start on page 249, the slide titled Performance Overview. We had a gain in the quarter of 3.6%. That equates to about $171 million gain in the national program. All strategies were actually up. Bio was up 2%, growth was up about 5%, was up about 13%. That's one of the storylines. We're starting to see some returns in the venture capital portfolio. That we started making commitments years ago on that. So that, a lot of those gains are from the 2022 vintage year, which has been great. And special situations was up about 4%. The 1 year return is at 8.6%. To compare that with the benchmark, the global private equity benchmark, that's at 9.6%. So it's about a percentage point lower, but we suspect that some of that might be driven by the J curve from our recent commitments. We have been committing a lot of capital. On a 3-year and a 5-year basis, we are outperforming the benchmark. And then when you look at the overall since inception return, it didn't really change much from the quarterly return. It's at 12% and over $4.8 billion gain. We break the portfolio down by the 2011 and after, and 2009 and before, representing when the new private equity strategy was implemented. And the 2011 and after is at a 14.5% net IRR and over $3.5 billion gain. And the 10-year return is outperforming the MSCI benchmark, the 10-year global private equity benchmark, 14.7% versus the benchmark of 13.8%. Just flipping the page, we did see a net asset value increase of $318 million. This is the first time that the National Private Equity Program is over $5 billion on a net asset value basis. Year over year, the table shows that there hasn't been much impact from those 1-year returns, just kind of a slight decline. When you dig into that increase in the net asset value on the next page, 251, you'll see that it's driven by really two main things. One is the return, about $171 million gain in the portfolio. Then also we had net contributions exceeding distributions by about 100. And that's a trend that we expect to see continue with the commitment activity that we've had, that the contributions will exceed distributions. We saw that for the full year 2025, where we had a net contribution of about $452 million. And even the start of this year, through mid-February, we're at a net contribution position of $54 million. So it is a trend that we're seeing continue. We did have a favorable gain loss ratio with 86 funds reporting gains and 59 reporting losses. Let's look ahead a few slides to the benchmarking. So this slide here shows a by vintage year look at the portfolio's performance against the private markets benchmark. We're targeting above median here because we are trying to create those diversified portfolios in each vintage year. And monitor exposures to manage the risk. And you'll see we're actually above median in almost all the vintage years. When you look at the 2011 and after, we are above median in all the vintage years with some top quartile performance in the 2016, 2019, and 2022 vintage years. So that's against a similar asset class benchmark. When you look at it again, the public equity benchmark, which is on the next slide, the public market equivalents, where we calculate an IRR from the public market indices using the cash flows of the National Private Equity Program. You can see we're only above the MSCI ACWI, which is a broad global benchmark by 0.6%. That difference has been narrowing. We're under the Russell 3000 by about 3%. A lot of that is driven by the Mag 7 exposure and outperformance. And then when you look at the Russell 2000, which is the 2,000 smaller companies, so that doesn't include the trillion-dollar tech companies, we're actually outperforming by 2.5% on that basis. On page 10 of the report, one new slide I just wanted to point out. So one of the strategy components that we talked about with the private equity structure study was getting primary exposure through the funds, but also, as you've seen with our fund commitment recommendations, we sometimes will bring sidecar co-investment funds as well. And so this is really the goal, to get no or low fee exposure to the asset class through what's called principal investments. So we added this slide here to really kind of show the results of that. And we've had some early gains in the principal investments right now, which has shown some good progress. But the caveat is there's still a lot of unfunded commitments there. So it's still early and performance can be volatile. And if you do need a reminder on some of the different aspects of the national program, we added a slide in the appendix that's a nice summary of all the components of the national program that we discussed in the structure study. So I'll conclude my remarks there, Mr. Chair, and happy to answer any questions.
Thank you very much. Any questions for Mr. Pugmire on the National Private Equity PMR? Just one question. Sorry, maybe I missed it. Where did you say the breakdown of the co-investments was?
It's on page 10.
Okay.
Which
Investments.
55. And you'll see it has a table on there that has primary fund commitments and then principal investments in the active commitments part.
Got it.
So it's only 172 million of the 5 billion net asset value, so a small portion right now, but from the commitment activity, about a third of the commitments that we've made have been in this section.
Yep. Okay. Any additional questions? Hearing none, I believe we're staying with Mr. Pugmire for the New Mexico Strategic Venture Capital Program review.
Great, thank you, Mr. Chair. I'm going to turn to page 271 in the materials. Start with the summary slide, and this goes back to the structure study that we had in 2025. We've split the report into two portfolios. One is the Legacy New Mexico program, which largely encompasses the 2018 and before vintage years, and then the Strategic Venture Capital Program, which is 2019 and after, and reflects when the advisor changed on the portfolio. And this slide shows the high level performance of the two programs. For the quarter, the 2019 and after had a increase of 6.7%, while the legacy portfolio had a loss of 9.4%. The 1 year and after is still challenging for the legacy 2018 and before portfolio. We've had some shorter term gains in the 2019 and after, with a 1 year return of 15.4%. What's interesting is you look at the global venture capital benchmark, and that's a similar return, 1 year return as the global venture capital, which I think is a great sign, because we're still building out this portfolio with the commitment activity that we've had over the 3 years, but generated a similar return on a 1 year basis. When you look at the since inception return, the 2019 and after is generated net IRR of 7.3%. But I mean, there is a shorter history there, and it can be volatile going forward, particularly as commitments start drawing capital. I mean, we see a J curve effect from the new venture capital funds as they begin to draw capital, which is also reflected in this performance. The 2019 and before program is still following some of the same themes that we discussed. I mean, there's been challenging performance, particularly in the co-investment funds. You know, these funds are about 59% of the net asset value of the legacy program, so they're still having an influence on the overall performance, and these funds are less diversified, so the movement of just one company can actually have outsized influence on the performance overall. So flipping to the 2019 and after section, just want to talk about the net asset value. The net asset value increased by 72 million to almost 500 million, and it's expected to increase more as fund commitments draw more capital. I think you can see the two categories here that show the fund investments, the recovery fund. The recovery fund is almost fully realized. There's just a few more loans left in that portfolio. You also have the top relationships down below, and you can see, you know, some of these relationships have been driving returns, you know, particularly ones that have more mid-stage to later stage exposure where you tend to get more performance uptick. The ones that are more pre-seed and seed are in the J curve and tend to take longer to generate performance. On page 273, I mean, you can see how the net asset value breaks out by contributions and gains. There was a net gain of 29.7 million, a net contribution of about 42 million to really drive that gain. We did have more losses than gains in the 2019 and after. 17 funds reported gains, 27 reported losses, which is not too surprising given where we are in the stage of building this portfolio out, because the J curve does have an effect. And if you look at the next page, just before you actually can see the size of the gains are a lot larger than the size of the losses. So that's driving it. And then on the recent development slide, which is slide 9 in the report, or page 275, we made a lot of near-term progress, continue to do so. I mean, you know, 3 things that we wanted to highlight, you know, this quarter, Kiera Computing and Roadrunner Venture Studios had a partnership announced. It was a $4 million partnership to build a quantum test bed at the Roadrunner Quantum Lab. And that's going to bring Kiera into the state with multiple full-time jobs. And, you know, that's part of the strategy that we had from the structure study, was not just focused on companies that are headquartered in New Mexico, but those that can move operations to New Mexico. So that was an important part of that. We hope this also creates a way to generate more high-skilled jobs in New Mexico with the evolution we're seeing in technology. Also, ABQNet launched this month as New Mexico's first open access quantum network. And then finally, the Strategic Venture Capital Annual Report was released, which has a lot of fantastic information. I want to recognize Molly and Charlie for their help in putting that together. It's really a fantastic report. It's on the SIC website. We've been referring fund managers to that to give them more background on that. And it's actually leading to more potential New Mexico investment activity, because what it does is it causes them to think about their portfolio companies and what operations they could potentially move to New Mexico. And that's part of what Chris and Bruce are doing in Los Angeles. So talking to venture capital managers about this exact topic as well. So we hope to have some good news from the work that's going on there. So I'll end on my report there, and happy to answer any questions.
Okay, thank you very much. A lot of great things going on. Any questions for Mr. Pugmire on the Strategic Venture Capital Program? Hearing none, thank you for your report. Thank you. Let's turn to our real estate EMR Director Sable announcement.
Thank you, Mr. Chair. A little quick intro and then hand off to Rob. A couple of things I want to highlight. One, the trailing 12 months for the portfolio has been relatively weak compared to our history over the longer run. outperformance continues to be sustained. There's been some drag in the portfolio related to J curve. Currently, we have about $3 million or $1 billion rather of committed not called capital. I estimate that is a drag on the order of 75 basis points from a performance perspective. And then was an idiosyncratic development. There was a wind down of a 2005 90-10 JV that was a 50 basis point hit on the portfolio as well. In terms of overall market dynamics, the income component of return streams is continuing to be stable on the order of 1% per quarter. The appreciation component has been under pressure because of the increase in interest rates. That does seem to have stabilized somewhat from where we are currently. Outside of the valuation impact, fundamentals remain strong and are arguably improving in the real estate space. Supply growth is moderating and occupancy ex office is continuing to be strong. I'll wrap up my comments there and hand it to Rob.
Okay, thank you. Good morning, Mr. Chairman and Council. It's good to be here. So the bottom line is the markets kind of remain the same and it's relatively slow. And we have to be humble because the real estate markets really haven't delivered much over the last few years for investors. It's frustrating as the impact of the interest rate environment continues to be challenging to real estate, and that's across the board. Really, it was an equal opportunity correction in the sector, and nobody was really immune to that. I'm going to start on our materials. Start on page 302, and at least that's where I'm going to start our materials, and talk a little bit about kind of trying to keep the big picture in mind. Where are we in the cycle? How do real estate fundamentals look going forward? Can we expect better performance going forward? And I think, the answer to that is we believe yes. We believe we're riding along the bottom of a market cycle, and but the fundamentals look positive in our minds, and that's good for performance going forward. Just to set the stage a little bit, your real estate allocation is 11% of your total investment portfolio is the allocation. Your exposure is much less than that today. You're around 7%, about $4.4 billion exposure to the market. So you're below your allocation target. So that's one silver lining is during a time when the market's just not delivering, you're underexposed to the sector. So that's a good thing from your overall plan performance. So where are we in the market cycle? On page 302, you can see on the left-hand side of this page, am I on the right page? I'm sorry, I might have the page number wrong. Let's go back to 300, maybe. There we go. Okay, I think I marked my numbers wrong. I apologize. So you see on the left-hand side of this page, we've had this cycle where markets were up and then the markets are down. And the chart in the upper left-hand corner of the page really says it all. If you started at the peak of the market a few years ago, where would you be today? And you'd be down about 24-25% in real estate. And the thing that I'm going to here is notice how the curve flattens out at the bottom, which is a situation we've been in for over a year now, where we've just kind of hit the bottom and we're bouncing along. And so as you think of a market cycle, I like to refer to this as the bathtub cycle, right? You're kind of get down to the bottom, you bounce along the bottom for a while before things turn around. From a pricing perspective, capital markets, interest rates are expected to come down. We follow consensus there. This really goes to the long end of the curve that we talked about earlier. Real estate is more sensitive to the long end of the curve. We do expect trending down interest rates, but not materially. We think the market has more or less reset to an equilibrium rate where the valuations look reasonable relative to where the interest rates are today. So to the extent there's a downward trend in the interest rates going forward, that should be positive for real estate valuations. If you turn the page to, I guess it's 301, this page talks about the market fundamentals, real estate fundamentals, and I'll just cover a few quick points. First thing, supply. One good thing about commercial real estate is when the market is bad, the first thing developers do is they stop developing. So what that means is a couple of years out, there will be less supply delivered to the market. That'll be beneficial to landlords, those who own existing real estate, because there will be less supply competing with their properties for tenants. So that's a positive. The bottom left-hand side of this page, occupancy remains high across all sectors in the 90s. 90% occupancy in all sectors except for the office sector, which is where it's hit the hardest since the COVID correction started. And then on the upper right-hand side, as we look at income, and part of this is estimates, but part of it is also kind of baked in because the leasing structures of buildings, they tend to be 3 to 5, even 10-year leases in real estate. And that the occupancy remains high and the rents are continuing to increase because landlords build bumps into their rental streams. So the income forecasts are positive across all sectors, even in the office sector going forward in real estate. So all things considered, the market is set to do better going forward. What we need is just a little bit more, I guess, transparency. It seems like we're in a wait and see environment where you don't have a lot of GPs that are investing a lot of money. If you have a property and you want to put it on the market, you probably want to wait and see a little bit longer to see how things play out, unless you're compelled to sell for some reason. So switching to page, I want to say 303, real quickly, your performance on your portfolio specifically, and the upper right-hand chart, that's your performance over the last 1, 3, 5, 10, and since inception, going back to 2004. And you can see it's pretty modest results across the board. Over the long term, your program is performing above its benchmark. And even during this correction, the 3-year period, you've done better than your benchmark. But the bottom line is the market has been negative. So it doesn't feel good, even though on a relative basis, you perform well according to the benchmark. As Keith said, the last year has been a challenge. We attribute that to a number of things. It's important to note that you did change your benchmark a year ago. So the hurdle was increased by 75 basis points over that time period. You look at the J curve, as Keith mentioned, and there are a couple of investments that we're looking at closely that are delivering or have delivered disappointing results, and that drag down your portfolio over the last 1-year period. So 2.2% over the last 1 year is your portfolio, and 5.9, just under 6% net over the last 10 years for real estate. Real quickly on page 304, I think we always say this, you have such a large, diverse portfolio, and that continues, and we will expect, I guess, more activity in 3 areas in your portfolio. Residential strategies, we spent a lot of time at the last meeting talking about housing, but we think that there is a housing shortage and there's a need for capital to go into that sector. And we expect to continue to look at housing strategies going forward. In the industrial sector, a lot of talk at the beginning of the meeting about tariffs. And the bottom line is tariffs are causing every manufacturer, every retailer, everybody to kind of rethink their supply chains. And what that means is how goods are coming into the country or being distributed around the country. And then you still have the impact of e-commerce and that. And so supply chains are changing. That means that there's a lot of activity in the industrial warehouse sector. And you have a nice overweight there, and that's been a very positive contributor to your performance recently. And then I look at I'm at the chart on the upper right, but the far bars on the right-hand side, the other category, we've talked about this, exploring some of these other nichier property types that are becoming more mainstream and trying to be an early mover in some of those sectors so that you can support new sectors that someday will kind of graduate into the core category for commercial real estate. The final slide I'll go over is on page 305, and we just like to report out that the program is in compliance with your guidelines in all respects. The only issue is you're still significantly below your target in terms of your exposure to the sector, but you do have a lot of unfunded commitments that are not yet called that will boost that exposure as the market picks up. And so with that, I'll stop there.
Thank you very much. Any questions on the real estate report? I have one question on 301, just on the office occupancy. Is it your expectation that that's just sort of businesses reducing their footprint with hybrid and remote work and that sort of thing, as those leases roll off, and that should continue, and maybe that occupancy even goes down further?
Yeah, exactly. I think everybody's rethinking how much space they need and how much space each employee needs, what their employment's gonna be. So all of those factors, it's a combination of, a lot more remote work, post-COVID, and then going forward with AI and what the impact is gonna be on employment going forward. So tenants are generally leasing, they're not growing their footprint, or they're leasing less spaces, leases roll, and new leases are signed.
Class A properties in major metros are doing reasonably well. If you get down or trade down at all in quality or location, then it's a much different picture.
Any additional questions? Hearing none, thank you for being here.
Thank you.
Let's turn to our real assets panel, please.
Chair, I'll just lead off with a couple of very brief comments here. Real assets portfolio continues to perform well, particularly the infrastructure sleeve, which is on the order of 90% of the portfolio. We're continuing to make progress in terms of the diversification targets that we're laying out in the structure study, both in terms of geography and underlying industries for that.
Thank you, Mr. Chair, council members. So I'll spend a few minutes just walking through the real assets performance for Q3 of 2025. We can jump ahead to page 341. So starting with the performance overview, it was a positive quarter, and the program has ticked up to a 7.4% net IRR, largely driven by positive momentum across the subcategories. On the bottom half of the page, you'll see how how strong the short-term performance has been. Really, if you look at over the 1 year, the 3 year, and the 5 year time horizons. On the next slide, you may recall 2025 was an extremely active year when it came to commitment approvals. We really leaned into what we would call fee advantage accounts. 36% of the capital was directed to those types of accounts, where these are SMAs on a no fee or no carry basis, which really expected to blend down the overall fee load across the portfolio. On the next slide, you'll see that quarter over quarter, the net asset value increased by 180 million, largely driven by your infrastructure investments. As you know, as Keith mentioned, infrastructure is the largest sub-strategy within your real assets portfolio, and it's been the largest driver of value. On the next slide, we show the NAV bridge, which is really illustrating how the net asset value has changed over the quarter. As a refresher, contributions increased the NAV, distributions decreased the NAV, and then there's just the quarterly gain or loss on the underlying investments. So in Q3 of 2025, there were roughly 117 million in contributions, 56 million in distributions, and 118 million in gains across the funds. Now, as we mentioned last quarter, we do expect to see contributions outpacing distributions, really just due to the large number of commitments that were made, and as those funds begin to call capital. Now, the next slide breaks out by fund with top 5 for largest contributions, largest distributions, largest net gains, and largest net losses over the quarter. Now, the next slide shows the public market equivalent. Now, the benchmark was one of the changes we made during the structure study. As we'll be leaning more into the value add component, we thought it would be appropriate to increase the benchmark from a CPI +3 to a CPI +4. And as we've been making more investments in the value add space, it will take some time for those funds to generate the returns, but we're already seeing great progress. And you'll see that we're basically there, the 7.4% return compared to a 7.2% benchmark. And lastly, I just want to highlight on the next slide, the diversification of the portfolio. We're in line with where we intend to be from what we decided during the structure study. You'll see diversification charts based on strategy, geography, and industry. So we'll conclude our remarks there, and we're happy to answer any questions.
Thank you very much. Any questions on the real assets PMR? Just one comment along the lines of looking back on 2025, it is remarkable just the amount of volume of commitments that you made. Do you have that number for the full year? And
in aggregate?
Yeah.
It's a little over. Yeah, so it's 2 ways of thinking of it. We would say it was about 2.175 for the year. The later two, September and October, were largely done and will be viewed as 2026 commitments. That's another billion or so.
Okay,
So, looking at a calendar year, it could be north of 3, but we would say it's 2.175 and another billion. We're already a billion into 2026.
gotcha. No, it's remarkable and congratulations on just deploying that much money and these types of investments in a single year.
Thank you.
Thank you. We'll now turn to section 4, finance matters, and our audit committee report, and recognize our audit committee chair.
Thank you, Mr. Chair. We recently met this week to review some of the financials in the audit committee. We went over the budget to actual, and we looked at we had discussions over BAR, and Mr. Ship can comment on that a little bit more in detail, but that's essentially it for our audit committee report.
Okay, any questions on the audit committee report? Hearing none, we'll turn to our CFO report with Mr. Ship.
Mr. Chairman, just one comment on page 355, if I may. I think John talked a little bit about the appropriation request for fiscal year 27 and the good success that we had there. I do want to point out on item number 1 as it relates to our budget that going into fiscal year 26, the fiscal year that we're in, we did not have any bar authority. And one of the successes that was had during this past session for fiscal year 26 is we got bar authority up to $25 million for fiscal year 26 and fiscal year 27. We will be doing a budget adjustment request probably within the next month or so to get us through the end of the fiscal year. But getting that bar authority was a big task, and I want to thank John for that. It was a big concern. And you might ask, well, why are you needing to do a bar? We have new funds. The budget adjustment or the budget request that is submitted is done well in advance of the fiscal year even beginning. And we've had robust inflows and great returns. And all of this adds up to needing additional money to pay our public mandate managers. And that's a good thing. And that's all I had unless there's questions.
Thank you very much. Okay, so more money, more problems.
That's true.
Any questions on the CFO report? Okay, hearing none, thank you. And we will move to governance matters and recognize Ms. Amy Chavez Romero.
Good morning, members of the council. On page 416 of your materials, you will find the 2026 Open Meetings Resolution. As you know, the Open Meetings Act requires all meetings of a quorum of the members of any board that formulates public policy or discussing public business to be open meetings that are open to the public. Any meetings that are subject to the Open Meetings Act require that reasonable notice be provided in accordance with the Act and requires that every policy-making board have an open meetings resolution to determine what notice is reasonable for its meetings. And that's what you have before you today. In paragraph 1, you will see the procedures for regular meetings of the State Investment Council. These are duplicated from previous open meetings resolutions. Notice of all meetings for the council itself is required to be 10 days, at least 10 days, and agendas must be posted 72 hours prior to the meeting. Meetings of the State Investment Council committee meetings must be posted at least 72 hours before the meetings, with agendas posted on the State Investment Council's website. In paragraph 3, you'll see provisions for emergency meetings Those are governed by the Open Meetings Act and are limited to circumstances that demand immediate action to protect the health, safety, and property of citizens, or to protect the permanent funds and state agency clients from substantial financial loss. Notices for emergency meetings must be posted with 24 hours notice unless circumstances require otherwise. And after an emergency meeting, any actions taken at the meeting have to be reported to the Department of Justice, and also include some discussion of the reasons for having the emergency meeting. Paragraph 4 allows for remote participation for both council and the council's committee meetings. Paragraph 5 includes provisions that provide for notice of ADA accommodation with regard to both the council's committee meetings and the council meetings. And paragraph 6 deals with closed session requirements. Because today you will have a closed session, I'll just dive into those a little bit deeper. Under paragraph A, you will see the requirements to enter into a closed session. If any meeting is closed during an open meeting, the closure has to be approved by a majority vote of a quorum of the council taken during the open meeting, and the authority for the closure and the subjects to be discussed must be stated with reasonable specificity in the motion for closure, and the vote on the closure of each individual member must be recorded. And only those subjects that are specified in the motion may be discussed at the closed meeting. Paragraph B deals with legal notice requirements for the closed session. If the decision to hold a closed meeting occurs outside of a state investment council meeting, there must be appropriate public notice as well. And the notice must include a cite to the specific provision of the law authorizing the closed meeting. After the closed session, the minutes of the meeting must reflect that the matters discussed in the closed meeting were limited only to those matters that were specified in the motion for the notice for closure. And under the Open Meetings Act, any action that is taken as a result of the discussion in the closed meeting shall be taken by a vote of the council in the open meeting. So anything that is discussed during the closed meeting, if there's going to be an action that results for it, must happen in a vote in an open meeting. Paragraph 7 includes procedures for remote participation, and we'll delve into those unless anyone has any questions. And that takes care of the open meetings resolution.
And Mr. Chair, members, just want to highlight that you were required to adopt our Open Meetings Act resolution annually. That's a requirement of the Open Meetings Act. There are no changes here from what you saw last year because of the great work that Amy did last year, providing a lot of cleanup and clarification in this policy. So I want to thank Amy for her great work last year. That we didn't see any changes that were needed this year.
Understood. Thank you very much. Are there any questions on this year's open meetings resolution?
Mr. Chairman, just one question. Hi, everyone.
Madam Treasurer, good morning.
Is there anything related, good morning, is there anything related to a rolling quorum in the Open Meetings Act? Or where would that be located?
There's nothing in the Open Meetings Act that speaks specifically to a rolling quorum, but rolling quorums are prohibited. So there can't be any member discussion of matters that would need to be held in a public meeting. So if there is a conversation that takes place outside of an open meeting among a quorum of members, that could constitute a rolling quorum that could be questioned under the Open Meetings Act.
Thank you. Thank you, Chairman.
Thank you very much. Any additional questions? Anyone would like to make this motion? I'm happy to do so. Based on and consistent with the resolution set forth in the public meeting materials, I move that the State Investment Council approve the 2026 open meetings resolution.
Second.
Okay, we have a second from Member Summer, I think was first there. Is there any discussion? Seeing none, could we have a roll call vote, please?
Treasurer Laura Young Montoya,
Yes.
DFA Secretary Wayne Probst,
Yes.
Nick Case,
Yes.
Catherine Allen,
Yes.
John Bingham,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer,
Yes.
Mary Roman.
Yes.
That's nine in the affirmative, motion passes.
Thank you very much. We are now on to closing matters. Any older new business or informational items? Well, I would ask if we have any public comment today.
Mr. Chairman, not today.
Okay, our next meeting will be Tuesday, March 24th, 2026 at 9 a.m. here in the cabinet room. I believe we may have a motion to enter executive session to discuss limited personnel matters. Is there anyone who'd like to offer that motion?
Make that motion, Mr. Chairman.
Okay, Mr. Sanchez, thank you.
Pursuant to New Mexico's Open Meetings Act, NMSA 1978, Chapter 10, Article 15, and in accordance with the New Mexico Attorney General's current Open Meetings Act compliance guide, I move that by a majority vote of the quorum of the State Investment Council to the vote of each individual member to be reflected in the minutes, the council entered a closed session pursuant to the exemption for limited personnel matters in section 10-15-1 H2 for the sole purpose of a discussion relating to the annual performance evaluation and compensation of the state investment officer, John Clark. Only this limited personnel matter will be discussed in this executive session.
Okay, we have a motion from Member Sanchez. Is there a second?
Second.
Okay, second from the treasurer. Is there any discussion on the motion? Hearing none, could we have a roll call vote, please?
Treasurer Laura Young Montoya,
Yes.
DFA Secretary Wayne Probst,
Yes.
Nick Case,
Yes.
Catherine Allen,
Yes.
John Bingham,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer,
Yes.
and Mary Roman.
Yes.
It's nine in the affirmative, motion passes.
Thank you very much. That concludes the current public session. We disconnected connecting this meeting and joining the other one.